And now we talk about first in first out. What does it mean? It means the the unit that we bought first, it will be sell at first. So first cost into the inventory are first cost assigned to the cost of goods sold. End inventory is based on latest costs incurred. So recall our so we have 10 units in our in our hand at the beginning, and then we purchase 25 at 14, and then we purchase 25 at 18, right? So inventory cost system first in first out means if there are 40 units sold, first in will be sold first. First of all, these 10 units will be sold. So answer is still 30 left, right? And then the next order is here 25. Still 5 left, right? And this 5 will be sold from now this order. So how much we have here? We have left 20 here. And what is the cost? Cost would be 18, right? And what is the cost of goods sold? We already know that this 10, this is multiplied by 10, this 25 is multiplied by 14, this 5 will be multiplied by 18. So this is the order we have to remember, that first in first out. Let's talk about that. Let me just remove it. Sorry, here I'm removing it. Okay, right? So okay, here see, first of all that 10 units are sold, and then 25 units are sold with this price. This is 10 prices, and the left of 5 left with 18, and that's how 20 units are on hand, and the price or the cost of those 20 units are 360. So cost of goods sold is, here is, we can just add all the amount, and it's written in our previous slide. You can just see that. Now let's talk about the last one, which is last in first out. Here it is. Last in first out, it means the item that we purchase last, right, that we purchase at the end will be sold first. It is not like a physical inventory method, right? It is just for the recording the cost, and we'll talk about that with the recording the cost with purpose of increase or decrease of the profit on for taxation purposes. It is not, we actually follow that in our stores or godowns, right? For example, the first purchase will be sold first, or the last purchase will be sold first, or average, just like that. So these are methods for just to follow accounting systems, or to play with those numbers. So let's talk about that. Last in first out, it is the opposite of FIFO, which is first out. So last cost into inventory go to the cost of goods sold. So it means the ending inventory will be of all desk cost. So in order to understand that, let's example. So we sold 40 units. Last in first out. So we have sold 40. So first of all, the last purchase was 25 at 18. So you less 25 at 18. Still we have how much? We have 15 left, right? And that those 15 will be at 14, right? So here it is. Let me just remove that. So it means here, it means the 20 left items here, they belong to 10, 10, 10 with 14, and 10 with this 10. Okay, so let's see that. right? Last in first out. So lastly purchased will be sold first, right? Lastly purchased will be sold first. So did you notice here something? That the ending balance of in hand is 240, while in LIFO it is more than 300. See the difference here, and look at the balance sheet, right? Balance sheet is decreased by almost more than 60. Plus the cost of goods sold is, you can see that, shoots up. Why? Because inventory prices list on the latest prices, which is the highest one, because there is inflation here. See? And let's talk about the implications. Okay, before implication we have illustration here. So I just want you to pause the video and try to solve it by yourself, and then we're going to solve it together. Okay, so we have Hazelwood surplus. They began March with 75 tents that cost 16 each. So during the month, Hazelwood surplus made the following purchases. March 3, they bought 95 tents at 18, costed this. They bought 165 tents at 20, costed this. They bought 35 tents at 21, costed this much. So Hazelwood surplus sold 318 tents, and at March 31st, the ending inventory consists of 52 tents. Sale price is 45. So we have to find out the costing of cost of goods sold and inventory on hand. When we talk about inventory, it already means we talk about inventory on hand through average cost, FIFO, LIFO, right? Let's talk about that. Average costing. How much sold? They have sold 318. So first of all, if we talk about average, average is simple. You add all the cost and you add all the goods that you purchase, right? You divide it by this number. See, average is total 3, ending balance is 370 units divided by total cost. So cost is 18.77. So 52 multiplied by 18.77, and 318 units are sold. So sold units cost is 18.77. So you multiply with 18.77 with the number of units sold. That is the cost of goods sold. Fairly simple. That is average costing. Let's talk about the FIFO, first in, first out, right? How many units we sold? We sold 318. First in, first out. So the units that we purchase first will be sold first. So we have 318. So this 75 will be sold at 16. We will count that, yes. And then 95, yes. And then 165. All units are sold, no, because when we add it, it will become 318, right? Not after that. So some units from 165 are not sold completely, right? Some units left, and this 35 units at 21, this is also not sold. That is the cost of inventory, first in, first out, right? So here we have 318 left, so we already sold it, so we're just gonna add it to find out the cost. When you add it, so that would be the cost, okay? And now LIFO, last in, first out. So 318, this 35 units will be sold, yes. The 165 will be sold, yes. And 95, yes, sold. And some parts that are 23 units that are left, these are sold at 60. So when you add all these units, so these units totaled 318. If you multiply with their respective prices, you find out the inventory here. The cost of inventory 6113 and ending balance 832. Did you notice something? That the LIFO cost is different, FIFO cost is different, and average cost is also different, right? So this is just for the illustration. So just pause the video and try to solve by yourself. The solution is already here. You can compare the solution. If you don't understand anything, please do write us in our WeChat group or our Blackboard discussion forum. So now let's compare these methods. So some points that I omit in our previous slides we're going to discuss here. That was intentional omission. I intentionally omit those points here to discuss in the slides. Here, did you notice something? That the inventory cost of FIFO is highest or lowest? Highest one. Average is in the middle, and inventory cost of LIFO is the lowest one. The cost, you see, cost of goods sold is lowest, right, in FIFO. In the middle is the average and highest in LIFO. So you can say that last in first out because there is an inflation. So latest purchase will be of course at as higher cost when we sold first. So cost will be highest. That is a logical point here. First in first out cost is lowest. Why? Because first purchase, the first purchase will be sold first. So the older purchase will be sold first. The older cost is lower. So that's why our costs are lower than LIFO. Inventory, it means recent prices of the inventory. Recent prices are used to measure the inventory on hand. So that's why inventory cost is higher in FIFO. Oldest price are used to calculate the inventory on hand. So that's why LIFO is lower. And in the middle, there is average. But did you notice one thing? Goods available for sale price is same. That is not very much important here right now. But the real point is to understand the segregation of inventory on hand, which is the item of balance sheet, and this cost of goods sold, which is the item of income statement. So let's move further.